So we're in the business of solving the compounding problem by creating convexity in people's portfolios, by changing portfolios so that they perform the best when you're wrong, when unexpected things happen, as opposed to performing the best or targeting their best performance at the expected outcome.
David Dredge, great to get you back on Real Vision. It's been a long time.
Yeah, it has been. It's good to be back. It should be fun.
Yeah, because a good old mutual friend of ours, Steve Diamond, said, "Listen, you guys got to chat." So I thought, yeah, let's do this on video because I want to catch up with, because I hear you've got some super interesting thoughts. But before we get going, for people who didn't see your video back in 2016, just give us your background because it's really interesting.
It goes back to forever.
We all do now. We all do. It's terrible.
Grew up in Utah. Went to University of Utah. Went to grad school at UC Berkeley, studied economics under Janet Yellen and financial derivatives under Mark Rubenstein, and took a job with Bank of America because I could stay in San Francisco and not go to New York and be too far away from home. 3 months later, they sent me to Singapore. So my ability to predict markets or predict outcomes was revealed very early in my life. And I arrived here in Singapore the first Monday of October, 1987. And,
no way.
And got told by, the senior guys, so lucky to come here, easiest markets to trade, own the markets, own the currencies, earn the carry, ride the yield curve, nothing can go wrong. And 2 weeks later, they nuked the entire drawdown limit, by 20x, and it sort of dawned on me then, and having obviously been I'd literally had just finished Mark Rubenstein's class on options and portfolio insurance, as his portfolio insurance business contributed to the crash in 1987, and kind of had a front row seat on it, on what we called Blacker Tuesday out here, where markets were far more Australia and Hang Seng were down 50% on the day. You imagine what the currency moves and unwinds of carry positions and stuff were. So, that sort of started my path to trying to figure out what risk actually was, as opposed to what banks seemed to think it was.
What job were you doing at the time?
I was just a young trader. I was FX trading at that time, or FX trading, interest rate trading, forward trading, whatever. And then, became the guy who went around and sort of set up their emerging market treasury and trading activities as everybody deregulated in the late 80s, and really got another taste of what the flaws in the risk process was, and the dynamic that my former Bankers Trust colleague Nassim Taleb always writes about, and what I do, this concept of make a little, lose a lot, make a little, lose a lot, and came up with this concept of what we eventually called a core risk business. The importance of embedding positive convexity in these markets that had fat-tailed risks, and were very nonsensical to use historical volatility and correlation as a risk measure. I mean, if the currency's pegged, what does historical correlation tell you? Nothing. And Bank of America had no interest in those ideas, but I met the guys from Bankers Trust, and they thought that was a pretty good idea, and they were kind of interested.
Because Bankers Trust were really kind of, them and CSFP, I think at the time, were the guys who kind of really understood the game, the derivative game.
Yeah, well, the CSFP guys were all ex-Bankers Trust guys. So
right.
And so we started this emerging market business, and this concept of using long convexity in the book as a counterweight to liquidity foregoing business activities. And once we could prove that we could manage risk from both sides, create positive convexity, then we would make markets and structure derivatives and underwrite credits and build investment management businesses and push into these emerging markets. And so, of course, back in those days, early 1990s, there weren't option markets in Taiwan equities or Korean interest rates or Indonesian currencies. So we came up with the concept of embedding short volatility and yield enhanced investment products that became, the core investment banking business for everybody in Asia over time to this day. And, in a sense, that's what we still do this day in our business here, is we sit in that food chain of volatility supply. and absorb where, think of ourselves as value investors or even distressed investors in volatility, and we absorb that excess flow when those imbalances build up, and everybody who's using flawed regulatory risk and accounting practices are happy to collect the extra premium carry coupon being short that vol and don't have to account for the tail risk they're taking. And so supply and demand inevitably get imbalanced in markets, and opportunities come along that we absorb into our book and manage risk then on behalf of our clients who are out taking more risk on the other side. And so I've been doing that out here, one way or another for 35 years, and know a little bit about that volatility supply.
And so let's get a couple of questions. Asia is a structural volatility seller, isn't it, generally?
Yeah.
Why is that? Because Taiwan rates and South Korean rates have been so low. Why are they such vol sellers?
Yeah, so it goes back to the late 80s in Japan and then early 90s in the rest of Asia. If you think about in the global balance sheet where everything is a yin and a yang, the global savings pool is Asia against the global deficit side, which is the West. And because of the currency pegs and the mercantilist policies, everybody tied their currency to a low saving, low growth Western world in what was a high savings, high growth, high inflation world. So you've had financial repression out here going back 3.5 decades, 35 years. And so, first Japanese interest rates went to nothing, and then Taiwan went to nothing, and then Korea went to nothing, and China, Hong Kong, Singapore, and you have all these pools of wealth. And if you think about the global banking business model that I used to be in, you used to be in, all of our Western clients, the business in the West was predominantly a borrowing client. The business in Asia was predominantly an investing client. That's the global balance sheet. And that appetite for the Korean pension fund to look for yield pickup, they're a natural seller of vol, versus the U.S. pension fund, who's getting regulatory capital requirements to protect capital and go out and buy duration hedges. And so you had this imbalance and this vol supply over time, which, we started back in the early 90s in their local markets when it overwhelmed that because of the scale of these institutions and of the consumer wealth. It starts to expand to the rest of the world. And so Taiwan insurance companies become the predominant supply of volatility in U.S. interest rate markets, and Korean retail investors are the predominant supplier of volatility in Euro stocks markets. And, Japanese banks are the biggest providers of correlation and volatility in global credit markets. And all of these levered structured products that play to the flaws of what, I don't know how much of my stuff you read, what I call sharp world mathematics, that play to the flaws in the sharp world mathematics, are happy to go out and lever this stuff up endlessly and in essence not have to account for or capitalize the tails.
And so you set up a fund specifically to take advantage of this. And I guess because you see when the market is structurally biased one way, you get dislocation events the other way. And therefore, at extremes, it's going to be wildly underpriced or in some cases overpriced. I guess that's how you look at it. And I guess being in Asia is also a sweet spot because of this structural difference.
Yeah, we're looking for supply and demand imbalances. So we want to embed ourselves where that supply percolates from. Now, since GFC and zero interest rates in QE and in the US and Europe, this sort of yield enhanced structured product embedded short vol has obviously picked up and grown quite significantly in the US and Europe. But it's 30 years old here. It's massively, relatively speaking, bigger here and much more diversified across asset classes. And I'm sure you're well aware in places like Hong Kong and Singapore, the retail deposit base in the traditional retail banks, there's far more domestic consumer deposits in dual currency deposits than there are in the domestic currency. The entire retail deposit base virtually embeds a short FX option. And so, back to the GFC, the entire one of the biggest volatility movers in the world was Aussie Sing dollar, as those dual currency deposits all get nuked, and everybody says, I don't care which currency I get delivered, suddenly cares, all at the same time. And that's, driven by Singapore retail investors, retail depositors. So yeah, I mean, we sit here and we don't have I don't have, and you've read some of my stuff. I wrote a piece in July entitled "The Pointlessness of Forecasting." I don't have a view. I don't forecast. I'm not a macro guy. I just observe.
So talk me through that process a bit, because people love that, the tail risk people have become kind of famous over since the global financial crisis, because of the outsized returns when everything changes. Talk me through the process of doing that, because people think it's all about, I need to create a doom and gloom macro forecast view and then do it, and it's nothing to do with that, really.
Nothing.
How do you do this? What is without giving away your secret sauce, but just the general process of how you think about this?
Yeah, I'm in a battle with Sharp World. So Sharp World is doing everything that's counter.
Explain what Sharp World is first.
Sharp World is is a meta fantasy amusement park where the mathematics of the financial industry hold true. Right? where distributions are Gaussian, where correlations and volatility are constant, where ensemble averages dominate time averages, where geometric compounding is irrelevant, where fiduciaries, I compare it to the Big Rock Candy Mountain. It's where fiduciaries just love life, but it destroys compounding for in capital holders. And so we're in the business of solving the compounding problem by creating convexity in people's portfolios, by changing portfolios so that they perform the best when you're wrong, when unexpected things happen, as opposed to performing the best or targeting their best performance at the expected outcome, right? As it turns out, not surprisingly, things that are expected to happen rarely have asymmetric returns. Things that are not expected to happen, whether they're, exploding higher private equity tech stocks or Amazon or whatever, or busts and sharp volatility correlation spikes, those things, if you construct a portfolio that benefits from them, to, again, Nassim's terminology, that's anti-fragile, will compound far, far better. And you get far superior risk reward dynamics in a multi-cycle investment portfolio.
And in your strategies, do you just offer the tail,
yeah,
or do you offer sort of some positive funding so it's not expensive? Because your job is to lose money in options until you don't, yeah, and then you make up more money than you've lost in options, I guess. Yeah. How do you deal with that? It's quite hard.
Yeah,
a lot of people fail at that job. Some people have done pretty well, but a lot of people fail at doing that.
Yeah. Yeah, it's hard. It's hard to play goalkeeper in an industry whose singular metric is goal scored, right?
Yeah.
And yet we would all agree, other than the flaw that the benchmark incentive is goal scored per game, we would all agree that in the actual objective, terminal standings at the end of the season, the goalkeeper is the most important guy in the field. Right. So our argument to everybody, so we only play goalkeeper, we only play defense. And we would tell everybody we speak to, and every pension fund, endowment, family office, wealthy individual, stop paying people for correlated risk. The market will give you correlated risk for free. Pay people for the negative correlation. Pay people to play defense. Now, there's not that many people willing to do it because the temptation to play to the market standard incentive structure is very high, right? But if you can find people who will do it, hire them, and then go out and take more risk, more, to your point earlier, you'll never hear me say doom and gloom, the world's coming to an end, you've got to be bearish. I have meetings with a pension fund or somebody like that every day, and 100% of those are guys who haven't taken enough risk. They're not taking enough risk. They haven't taken enough risk
because they can't.
Yeah, because the concept of risk management in Sharpe world, the 60-40 model, is to reduce risk, right? The whole concept of the Sharpe ratio is that upside volatility is just as bad as downside volatility. Now, in a compounding path, that's obviously, absolutely, completely wrong, right? And so, as Nassim or Mark Spitznagel would always say, the whole point of having good risk mitigation is so you can take more risk, right? The guy who wins the 40-lap Formula One race is the guy with the best brakes because he can drive the fastest. He has the least likelihood of crashing, and he can go faster than everybody else in the good parts. And so the traditional investment model, the traditional Sharpe world model, 60-40, Kelly criterion, is just reduce the risk, reduce the participation on the upside, take 40% of the capacity out of the engine, drive at 60% of the speed, and based on a 1.5 lap look back, probabilistically say we probably won't hit any curves that will crash on going at 60%. But you don't participate in the upside, and you're just grinning and holding on every curve that comes along, hoping that this isn't the one that you judged badly. The guy with good brakes accelerates, decelerates, accelerates, decelerates.
And you can see this in hedge fund returns over time. When you and I started our careers, hedge funds had, like, depending what kind of structure, 10 to 15% volatility and 20 to 30% returns. That got crushed down by this whole kind of Sharpe world, as you call it. And the average hedge fund now is doing 4% volatility and 6% returns.
Yeah, they've all played into the metric. And then it's the hedge funds metric, it's the pension funds metric, it's the sovereign wealth funds metric. It's become obsessive, and this is in a sense where my current writing is. Driven by a call it the Greenspan era, right? Beginning with October 87, creating this negative correlation that previously didn't exist between bonds and equities when he cuts rates when equity prices fall, and then gets accentuated in the mid-90s when Greenspan and my old professor Janet Yellen and crew start to work towards this inflation targeting dynamic and decide to define price stability as at least 2% as opposed to 0, which actually was Greenspan's opinion at the time. But everyone conceded to Professor Yellen because she otherwise wouldn't go along with it. You got to go read the July 1996 transcript, FOMC transcript. It's fascinating. So this has produced an era, the window of the unprecedented anomaly of I quoted Ricardo Rice back in July and showed a picture in a paper that he had done that had 20-year blocks of UK inflation, mean and volatility of UK inflation over 20-year blocks going back to 1300. The beauty of the Bank of England, right? They've got data forever. And the obvious anomaly, and so each point, the horizontal axis is the mean inflation for that period, and the vertical is the volatility of inflation over that period. And there's one dot that stands out above all others, and it's the 20-year block that he has of 1997 to 2016, which is a dot right on 2% and right at the bottom of the volatility. Everything else in the chart's up here and out here, right? So the anomaly of this creation of this stable volatility environment, which led to forever declining interest rates, probably, aided by globalization and the influx of mass labor force in China and India and Asia and emerging markets, created this anomaly where Sharpe world mathematics, looked beautiful, right? You had perfect correlation for, forever falling interest rates, low volatility, low inflation volatility, low economic volatility, low interest rate volatility, low equity. Everything was perfect for the sharp world mathematics of performing at the mean. And yet, risk parity, the sort of pinnacle of sophistication in sharp world, everybody who's used it for the last 25 years, is 75% funded. So I go around and give presentations at pension fund conferences, and any pension fund crowd is some spectrum between simple risk parity to advanced risk parity. And at the end of 2021, every asset class in their universe was at an all-time high. They've come through a multi-decade period of falling interest rates, perfect correlation, perfect central bank reaction function, and they're all massively behind their target. What's wrong with this scenario? And then I show the simple pictures of something that was, structured with convexity, something that's just agnostically beta and protection, is massively, multiple times in terms of terminal capital outperform that. No sophistication, no timing, no allocation magic, no anything, just convexity. Just because you then...
But talk me through how you find that convexity, right?
Well,
because it's not for everybody, right? It actually takes a lot of understanding, analysis, and work. So talk me through a little bit about that, and then I want to come into Japan and some of the big convexity, weird mispricings that are out there.
Yeah, there's different ways that different people do it. One, it's hard, right? Playing goalkeeper is a lot harder than people think. Right? Investing, in a sense, time is the main dichotomy. When you invest in something, time's your friend, right? You accrue the earnings, the coupon, the dividend, and each day as the duration of that gets shorter, your risk gets less. And so investors do most of their work before making the investment. And then once they've made the investment, they move on to something else to, further diversify the portfolio. But when you're on the other side of that, time's your enemy, right? When I go out and construct a convex liability structures, in a sense, I'm managing liabilities, and there's a cost with that, and my sensitivity, my asymmetry to some outcome gets less every day. It starts, at its peak, and then tomorrow, there's theta, there's decay, there's et cetera. And so, it's a constant beast, to play goalkeeper. When you've committed that your job is at the end of the season, you're going to be, end of the year, you're going to be a bigger, stronger goalkeeper than you were at the start of the year, despite the fact that what you own is naturally losing strength and sensitivity every day. And so people go about it different ways in different markets, and because the nature of tail events is very path dependent. I always use the forest fire analogy. In a forest fire, only one tree starts on fire because of the lightning strike. The risk to the system is the contagion as the fire spreads from one tree to the next. Every other tree catches on fire because of the tree next to it. And so every forest fire is the same in that sense, but every forest fire is different. How it starts, when it starts, where it starts, how it spreads, which direction the wind blows. The similarity, and in a sense what our task is to go and find the parts of the forest that have the most dry tree and brush, right? Because the actual risk isn't the exogenous probability of a lightning strike. It's the endogenous risk of how much combustible material is built up on the ground. And so, the again, sharp world, value at risk, says, well, the last bad fire was caused by a lightning strike. So we're going to build a model that predicts the probability of a lightning strike, and says because there hasn't been a lightning strike for a long time, there's not likely to be one. Right. And so everyone's got their models pointed up in the sky predicting lightning. And then all of a sudden the forest catches fires because kids were playing with matches. And they all say, well, nobody could have seen that coming. Meanwhile, the exposure to super senior tranches of subprime CDOs with no capital backing any of the correlation risk embedded on them is staring them all right in the face. just the regulators and sharp world risk accounting doesn't make you account for it. And so the fiduciary, who has no skin in that game, has none of the downside, is happy to continue to pocket the levered carry component of that and ignore what the actual risk is. And so the way we construct what we do is we embed ourselves in the implicit leverage of volatility selling and just help people recycle that when it's piling in on something because every German pension fund is doing Bermudan swaption embedded callable note structures. The banks have more than they can possibly get rid of. And as it turns out, and don't tell anybody because this is truly the secret sauce, as miserable and hard as being the goalkeeper is, of being the insurance provider in an industry that doesn't want to pay for insurance. Yeah. The one good thing is the biggest risk, the biggest accumulation of dry brush and dry trees in that forest lines up with where the insurance is the cheapest. Right? Because it's that application of the leverage that is sort of the interconnecting dry brush between the trees, right? So the best hedge for the GFC, or one of the, probably actually wasn't the best hedge, but we can come back to that later. Super senior tranches of subprime CDOs. When were they the best hedge? Well, when they were trading the tightest to U.S. Treasuries. Why were they trading that tight to U.S. Treasuries? Because banks had managed to construct them as zero risk-weighted assets and could lever them infinitely. As such, at exactly the time they were priced as the least risky is exactly when they were the most risky. And then as soon as that correlation adjusts even moderately, it wipes out all of the capital in the banking system. And it's, as well as anybody, it's not like the banking system was unregulated. It's exactly the opposite, right? It was just wrongly regulated. And so that's what we do. And we're very agnostic. We don't care if that vol selling's equities or FX.
No, but here's something interesting is, we've all obviously observed and tried to get used to, and you've been in Asia longer, so you've seen more of it, quantitative easing and these very heavy-handed management of economies, financial risks, and everything else. It's like they don't want the collateral to go down because in a leverage system, everything goes bust, right? So everything you do is stop the collateral imploding. And the pandemic, we saw, fascinatingly, the Fed cross that Rubicon and we'll buy mortgage bonds, we'll buy corporate bonds, we'll do everything, which is basically they're saying if there is a black swan event, it can only happen for a very short period of time until we turn on the printing press and get it sorted out. Because in my view, the printing press, what it does, the quantitative easing, particularly in US dollars, is it's debasing the currency. So optically, the denominator changes, therefore the asset price goes up. And so that gets rid of the effect of the essential liquidation or insolvency at system-wide level. That must have changed the structure of things for you, right?
Yeah, because
it's not 1998 Asia again. I don't think we can have that again right now under the current mechanism.
We'll see. Right, as I always say, in a somewhat one of my more popular pieces, I think it's the August 2021, I wrote a piece titled "Self-Organized Criticality," and I compared the withdrawal from Afghanistan and the weekend-long takeover of Afghanistan by the Taliban after 20 years of holding them back. Why would the almighty U.S. government, U.S. military allow the Taliban to take over Afghanistan in a weekend? Because they decided to. They decided, for whatever reason, the cost of the indefinite perpetual prevention of it was too high. So they left. And I used the analogy to, what I had at that time been saying for a while. The biggest risk in this system is rising interest rates. And everybody's pushback in 2021 was, why would they let interest rates go up? They let interest rates go up, all this bad stuff would happen. Why would they do that? I said, well, I don't know, but I assume same thing. They decided to. To this day, I still think that's the best explanation of what happened. They decided to, right? And, I'll say the same thing over and over again about Japan. Why would Japan let interest rates go up? They can't let interest rates go up. I mean, look at 260% debt to GDP. Interest rates can't go up. Why would they let interest rates go up? I don't know. Someday they might decide to. They don't have to.
So talk us through this Japan thing, because this is a market that is the hedge fund graveyard, as you know. Everybody's had a view and now nobody trades it anymore, which is something I think that you would take as a signal as opposed to noise, that when nobody's trading it, the vol structure's crushed and nothing ever happens, it kind of gets interesting, because anything at the margin changes, you can get some outsized things happening. So talk us through your Japan theory, because this is what Steve said. He said, you've got to speak to David about this.
Well, my Japan theory is the same as my overall theory, right? It's just a particularly acute example of it. So, you go back and read all my stuff, convex-strategies.com on the website. I've been writing for quite some time. Well, I actually had my initial comment about it in early 2010 in a discussion with the then New York Fed president. And simple premise about QE and zero interest rates. My simple question always has been, what if it works? Right? What if, after whatever undefined period of zero interest rates, negative real rates, endless QE, what if it finally works and you decide you want to reverse it? Is it not inevitable that you would have built up the greatest imaginable sensitivity to rising interest rates the world has ever seen? Obviously, right? If you couldn't foresee where this was going, I have to wonder what you know about economics, financial markets. What do you think they're trying to do, right? The persistent, solving a credit problem with more credit is going to end up with a credit problem that needs more credit, and so, Japan takes that to a maximum extreme. And as I wrote about, I've been writing about Japan for I don't know how long. I dubbed it the most dangerous peg in the world back in March of last year. And it's the most dangerous peg in the world because, one, it is the grandfather of structured product activity, right? It's the first place where interest rates got really low and a large household savings pool out searching for yields. And anything and everything you can imagine in terms of exotic bells and whistles has been done in Japan on every asset class domestically and globally for 30 years. And nothing is more, that stuff is sensitive it is to Nikkei or dollar yen or CLOs in the US. It's maximally sensitive to Japanese interest rates. That's the whole point in being. And every single one of those structures is sensitive. The present valuing of it is sensitive. The optionality is sensitive. The row of the embedded options is sensitive. The forward price of 25-year power reverse dual currency bonds and the correlation is sensitive, right? It's all sensitive to interest rates. And so you have this, I describe it as the canopy of a tree. If you think of the canopy as the derivative overlay of activity in the market and the trunk as the underlying market, well, the trunk in this example is the JGB market would look like a toothpick, right? Compared to the scale of the derivative activity that has developed over the years, and particularly in the last, decade under Kuroda, where the central bank has taken out most of the underlying market, the JGB market, and put it on their books. It doesn't trade anymore. The JG market basically hasn't traded for years, other than the dance where the finance minister issues on a Tuesday and Bank of Japan buys it on a Wednesday, and the banks sit in between for a basis point. Right? And they call that not directly monetizing the debt. So that's one. So the market has a lot of conditional sort of Bayesian type risk to a repricing of interest rates. Two, you have this problem that more so than anywhere, interest rates can't go up because at 260 something % government debt to GDP, the impact on their fiscal circumstance. So it's the largest debt to GDP of any modern economy in history. And, running it, depending on whose numbers you use, an 8 to 10% fiscal deficit, annual fiscal deficit. And if you double interest rate cost, triple interest rate cost, where does it go? And that number immediately becomes unsustainable. And then number three, and this is why I think it, particularly relevant to the world, Japan is still the largest foreign net creditor in the world. So they own more foreign assets than anybody else because all this money printing, they've got offshore and bought stuff. And they're the biggest fixed income owner in pretty much every government bond market in the world, other than the domestic, whatever forced savings pool. And so it strikes me, and I talk about this not just about Japan, about everybody. And in my, are they going to close the gates of Sharp World? So, as I accuse Sharp World of scamming global savers into owning government debt at no yield, as every major government in the world blew through 100% of debt to GDP. So, any right-minded, capital-preserving, terminal capital targeting retiree would not own UK gilts at minus 4% real yields, right? But the pension system on their behalf will own them 3 times leveraged in LDI, stupid, Sharp World risk management structures. And so as the whole world, think about that, the whole point of making, in the negotiation back in the 90s around BIS regulatory capital, of making sovereign bonds, particularly periphery sovereigns in Europe and the Eurozone, zero risk-weighted assets, was to get the banks to hold these things so that you could spur growth and play catch up with the periphery countries. And the whole Solvency II in the insurance industry is to get insurance companies to own government bonds. LDI and risk parity is a scam to get the fiduciaries to allocate other people's capital to owning things that had zero chance of long-term compounding, zero benefit to the portfolio. And now that's sort of, well, I like to think it's been, the curtain's been pulled back and the Wizard of Oz is back there, and people are going to say, hey, that's not a good deal for me. And yet the governments, Japan most extremely, still need to finance all this stuff at interest rates that will allow them to survive. And so I think, and this is what I wrote about last month prior to what happened with the BOJ meeting in January, some form of subsidized, incentivized, forced domestic holding of government bonds is coming everywhere. Now, that already exists with all of the regulatory requirements across banks, pensions, insurance, but it's going to get strengthened and dialed up and become even more sort of domestic specific.
So it's kind of regulated, regulatory QE, i.e. the government can issue more debt because the pension system or whichever part of the system, the banking, is forced to hold it.
Yeah. And that's in a sense what Bank of Japan did in January. They said, well, we'll give the banking. So the problem, number one, right, the canopy of derivative overlay, there was not enough DV01 available in the remaining bonds that Bank of Japan could buy to satisfy the DV01 hedging requirement in the derivative overlay. So their efforts to keep rates low, which has become their singular objective, right? So when they started this policy, they said their objective was to achieve 2% stable inflation or was economic growth or something. The objective now is very clearly just keep rates low. That's the objective in and of itself. But they were losing the ability to do that because there weren't enough bonds to satisfy this hedging need in the nonlinear space of derivatives. And so they've solved that problem now by interjecting the banks again and saying, we'll provide you subsidized funding if you will hold these bonds. And so there's now a anti-competitive benefit to Japanese banks beyond what already exists with risk-weighted regulatory capital requirements to replace less profitable zero-risk activities with this one. So instead of Bank of Japan buying 5-year bonds, which they were doing prior to the meeting at 24 basis points, the Bank of Japan is now lending to the banks at 14 basis points, and the banks can go out and buy the bonds. And so they've solved this problem because as opposed to they were limited previously to the available bonds within their YCC construction, now with the term lending facility, they've upped the capacity to the entire stock of assets in the system. Anything that qualifies as collateral can be put up. It doesn't have to be available to sale. It can just be put up as collateral, and the banks can take it and then use the money to go and buy whatever they want. And so
it's kind of what the ECB did similar, right? They basically said, we'll take any piece of trash that you've got.
Yeah. But the ECB was even better, right? Because they let each sovereign central bank define what was eligible collateral, because it's actually the Bank of Italy that takes the collateral, right? And so you literally, Italy's like, well, we're going to literally take kitchen sinks. And so you could bring your kitchen sink, we'll get money, from the ECB and give it to you. So, and this is, I linked in my write-up to my old, Asian crisis scarred friend, Russell Napier, in a video he was giving, talking about the exact same thing in the Eurozone, saying that this problem, this necessity of forced domestic financial repression is going to find its way to the Eurozone, where it's particularly complicated because, in essence, the fiscal authority is taking over from the monetary authority, and the French government is going to say French savings must finance French debt. You can't take French savings and finance Dutch debt. And so you get to this crazy concept. It's Europe's not just going to have capital controls in and out of the Eurozone. They're going to have capital controls inside the Eurozone. Right? Some sort of, how else are you going to get people to own all this stuff if the Dutch pension funds, who, as somebody told me, are much more sophisticated than the UK pension funds in their LDI strategies. And I said to him, you mean sophisticated like Bear Stearns and Lehman were, that kind of sophisticated, right? Sophisticated in advanced sharp world techniques.
Exactly. So listen, one of the theories I've been mulling through, and it was kind of a bit of a light bulb moment. I stepped back from all of this, and we'll come a bit into Japan in a sec again. I stepped back from all of this and thought about this level of rates and thought about, okay, what does this all mean? And you look at GDP growth, and GDP growth is population increase plus productivity and probably plus debt growth, right? That's basically the equation for how GDP works, right? Debt growth itself is not growing as significantly as it was because of the structure in the system. GDP, because of aging populations and productivity, has collapsed everywhere. So when I looked at it, I thought, okay, what is GDP? Well, GDP is what is GDP growth? It's the amount of money available to service your debt. Because if not, you shrink the economy, right? So it has to come out of GDP growth. So if US GDP growth is averaging at 2%, you can't have rates above 2% for a significant period of time without it cratering the economy. So therefore, and it's very cyclical. Every time the maturity of the debt, which is about 3.5 years, comes up, we get an economic cycle and stimulus comes in. And then I was just thinking through, talking about Japan, it's actually probably the same. I'm not sure what the trend rate of Japanese growth is, but if we multiply, the problem is when you get to 100% of GDP, right? Because you crowd out. Because in the US, you've got government at about 100% of GDP, and then you've got the private sector, it's about another 120% of GDP. So one's crowded out the other because not enough GDP. So that one has to go on the balance sheet. And then in Japan, you look at this and you go, same thing is going on here, is 20 basis points rates. GDP growth is, call it 2.6 times that, because that's what the debt leverage is. That's what you have to pay for. And anything above that has to get monetized. I'm just starting to think through that actually this monetization is something broader. So it feels that the monetization that's out there is this interest payments, which is why, as you say, the system just doesn't want and can't allow it because of the economic shocks. But, and I think your point is really interesting, until they decide to.
Yeah.
So in Japan, what would that mean?
Yeah, this is the catch-22, right? This is the sandpile theory, right? You've lost control of price stability, so interest rates have to go up. But interest rates can't go up, and so your argument in essence and is that you must forever have negative real rates, right? Is the only solution. So the solution
until
to
you
what
can get GDP productivity to rise, because the population things is already it's destiny, right? So it's only productivity.
The solution to your problem is the game, and I'll argue this is the game they're playing, between nominal and real, right? So you're quoting real GDP numbers, but they're trying to game nominal numbers. So if they can grow nominal at, 7, right, while interest rates are 3, they can get away with it. They figure they can run it down. But, think about what we're saying. I mean, you and I, reasonably rational guys, are saying the system cannot function with positive real rates. And yet,
no, I strongly believe that.
Yeah. And yet, we would, whether we're Austrian biased or not, would say a rational system should have positive real rates. You're creating, structural forever distortions by not having positive real rates. I don't know if you read Eddie Chancellor's latest book, the Price of Time, and
no.
You're creating the structural flaw. Back to my earlier story about the long-term series of UK interest rates, that anomaly of artificially low inflation, artificially low volatility of inflation, and inflation right on the 2% target, we are now obviously diverging from quickly. And the ability to rein that back in a world where you want to play this game of, and this is a game that Arthur Burns talked about in his mea culpa after he left office and turned things over to Volcker. We tried to play this game where we were gonna wink wink constrain inflation with nominal yield adjustment, but keep things ticking along with still negative real rates. And all we ended up doing was hurting the economy because of the added cost of nominal real rates, and making inflation worse because we kept the cost of borrowing below the level of inflation. And you end up never solving the problem until, in that case, a Volcker came along, or in the case of the previous sort of cycle, the world went to war and destroyed the excess physically. So, this is sort of the fundamental flaw in the system. And as we diverge from that, and how we figure out how we're going to handle this sandpile problem of too much, forever propping up this solvency risk, the fragility of the sandpile, with constant liquidity pouring on it to pack it down, which has the negative externality of inflation, wealth inequality, bad wealth segregation dynamics, which leads to socio-political instability around the world. And you end up
suppression of volatility always leads to volatility elsewhere, right? You don't get rid of volatility out of the system, so you suppress volatility. What you create is populism. You suppress, it's once you don't let things freely trade, it expresses itself, or it all blows up.
Yeah, which is, from a, not that we need to talk about my business, but from a business perspective, I already gave you the example that during this anomaly period of unprecedentedly low volatility of the key sort of economic variable, price stability, which led to low volatility of markets, interest rates, everything, the utopian world of sharp world, even in that world, a positively convex portfolio massively outperformed. What's it going to be like when we go back to a more normal world of persistently high volatility inflation, high nominal GDP volatility. I mean, look at the nominal GDP volatility over the last 3 years. I haven't seen anything like it in 30 years, 40 years, right? And look how that, and so you create, and what you see in this chart, right? The divergence from the 2% target of inflation is the average is on both sides, right? You have periods of really high inflation, periods of really low inflation. What you have universally is high volatility of inflation, right?
Yeah.
And to me, this is, just makes the case again for structuring your portfolios so that they're resilient in the wings, right? In the unexpected outcomes.
So in Japan, where we've established here that, okay, there's a huge concentration of suppressed volatility, essentially, right? So that gets David's radar up and I'm not going to predict whether this falls apart, but if it does, it's wildly mispriced.
Yeah.
So which part of this, because there's a lot of component parts, whether it's, where's the cheapest vol in this? Is it just the rate vol? Or do they not do the rate vol? Because the other game that I really enjoyed was you've peg rates here and the currency collapses. You've got, that was a nice trade because vol was pretty low there. How do you structure, or do you structure bits of it and say, I don't really know which bit blows, but one of them's going to, one of the legs?
I'm a sucker for supply. So when the supply was its most extreme, right, when everybody was selling vol to create enhanced yield, where complex Bermudan swaption callable structures were getting sold right down to the retail depositor. So you can walk right into your regional bank in Fukuoka, retiree, and get your 20-year, 1-year call deposit. And every year that rolled over as a 1-year, just like it was a 1-year deposit. You got your pickup in yield, and you go in the year and you take your money out and you take what you need for your grandkids' school and for your assisted living center rent, and roll the rest in the next one. But then, this year you're not getting it back. It's now a 20-year deposit because yields have gone up. It's not getting called. And so, when that's going on, the cheapest vol, whatever's the cheapest vol in the world, whatever's the most active vol supply, somebody's calling me because I'm the last guy who's willing to buy it.
Because the banks are choke full of it, and so
everyone's full.
Call David up and say, David, do you want to take some of this stuff? We'll give you a special discount.
Yeah, all the short-term directional trading, active hedge funds who are worried about, annual, quarterly, monthly, weekly performance have gotten crushed with it. Nothing's happened. They're not going to buy it anymore. They've had enough, and then it gets to me, and I'm happy to buy longer dated stuff, and happy to think about ways to maybe better isolate some of the sort of fourth movement type stuffs, volatility of volatility, and different parts of the convexity surface as opposed to the less asymmetric volatility itself. And then I own it. I own it long dated and costs very little to own it. And if we construct it well, right, we can really isolate, if they've been forced to dial their parameterization around the more complex third and fourth order derivatives, and I can isolate vol of vol at zero, well, it doesn't cost me anything to own it. And I have something that's really highly asymmetric, because my guess is if yen interest rates go up 50 basis points, the all-time low of at the money vol is probably going higher. And so what's happened this year in Japan, and I showed pictures in the last update, I've shown them a few times, the biggest relative repricing in volatility in the interest rate world last year was in Japan. On a relative basis, it went up a lot more than Europe and the US, even though the interest rate didn't move, right? Which is an indication, again, of the sensitivity to this risk. So as much as you think euro interest rate vol and dollar interest rate vol went up, Japan interest rate vol on a sort of relative basis went up a lot more. And so in some ways, a lot of the money's already been made. And that repricing of the skew and the wings and the convexity, to a great extent, has taken place.
So that took place because people started realizing there was a potential risk, so they started hedging. So that pushed up the
Yeah.
vol structure overall without anything having to happen, but the market becoming more aware of the risk of being so short vol, I guess.
Yeah. Yeah. As I say all the time, that because the government told them so, everybody was happy to go out and sell insurance around the base of the mountain because it was a mountain. And then suddenly smoke started coming out of the top of it, and people said, holy shit, it's a volcano. And the price of insurance adjusted really aggressively, right?
Now, we've just had a kind of globalized bout of volatility, both in underlying economies, inflation, interest rates, and it's big, right? It's a very, the rate of change of interest rates was one of the highest in history. The rate of change of inflation was, pretty high compared to all of history. So that must take away a lot of opportunities. This is the time to harvest the cheap vol. Where else outside of Japan do you start to see volatility coming down to levels where people you should be interested, or people are making mistakes?
Yeah, it's so right now in terms of our activity, we're obviously a lot more active managing stuff that we invested in 2 years ago, 3 years ago, 4 years ago, right? And there's much less of adding fresh stuff to the book because the supply of volatility isn't what it was, as people are getting cleansed out of this stuff. Now, interestingly, the last 5 weeks, volatility's come down a lot. Even equity volatility's come down. Now, our book was loaded up with equity volatility going into March 2020. Since March 2020, we bought none. Other than some single name stuff in Hong Kong last summer, which worked out. Alibaba and Tencent worked out fairly quickly. When after the whole world decided that was the time to do accumulators on those names. But equity vol has been unattractive through this entire cycle. And I assume some mutual friends that have had a really tough time, my friendly competitors, but that are far more focused on that specific sort of VIX S&P as their tool, as their toolkit, have had a really tough time because it was overpriced. It wasn't an efficient, cost-efficient way to create convexity. And then, trying to play goalkeeper, timing it, or, doing an RV trade tends to make for an inefficient goalkeeper, an unreliable one. And so, but as that's getting cleaned out and more enthusiasm, we'll see how this rally goes. More enthusiasm comes in. For the first time in a long time, we were talking about some equity vol today, and some supply is, the market that has had the biggest bounce off the October lows is Hong Kong, right? And so those names that were so beaten up last year, are up 100% from the lows in October. And that's generating some fall supply again. And we'll see if any of that gets interesting enough. There were some interesting opportunities already in topside vol before this thing turned around and went the other way. And, when even in S&P, when vanilla vol was getting low, but skew was still expensive, that made topside very cheap, and probably a good signal for why you were going to get a bounce that might actually generate volatility, and you have sort of positive spot vol correlation like you had yesterday. So there's stuff out there. The thing that stands out the most is probably credit, right? Credit, you've got the fixed income market in most places, but most specifically the US, pricing very explicitly for a recession just around the corner. Central banks have been telling us for over a year, a recession's just around the corner. And yet most credit markets aren't priced like there's going to be a recession. So that means, at least if you want to say, well, I think there's going to be a recession, how do I protect against it? Well, that might be one place to look. I myself don't think that way, but I don't know if there's going to be a recession or not. I just care about the price.
It was really interesting just to show how differently you think about things is, you're buying volatility when nobody wants it, which is, a thing people talk about in markets, but don't really understand because, I've been trading fixed income for 30 years and volatility was so expensive through this entire thing. You couldn't do anything in options that made sense. And the only way to have done anything was to have bought it 2 years prior.
Yeah. Yeah.
Because, vols were suddenly, Eurodollar vols, which normally would have been, 20, were 80. It's like, well, you can't do anything.
Yeah. If October 2021, when the RBA let their YCC experiment go, and the first realization that Europe was going to have to join the party. And so you had that late October 2021 move, potentially, most specifically Australia and Europe, and immediate repricing off, historical lows of volatility. And if that, clicked your attention, oh shit, something's going on here. Maybe I should go buy some options. But you look at it, the relative change in the price of volatility from where it was a month ago is so big, you're like, well, they're not cheap now. But they actually were cheap. Now, they were incredibly cheap a month before that. I mean, historically, December 2020, U.S. interest rate volatility, convexity, skew, term structure, vol-of-vol, all of the cost components that go into owning optionality was the cheapest it had ever been. Ever. Well, not ever. Since I've been paying attention since 1987. So I'm not sure how active the interest rate vol markets were before then, but is the cheapest we'd ever seen. And then by the summer of 2021, Euro was the cheapest it had ever been by miles. Right? And guys were just desperate to sell us stuff. And of course, Japan had been cheap throughout that whole time and continued to be cheap right through the end of 2021. So, going into, even early this year, even after these things had all started to move in October, you still buy Japan for well, at the money normal implieds for teens volatility when, dollars and euros were now up in the 80s. And so there's always these weird anomalies. January of last year, what was the cheapest, the way we look at it, and obviously very subjective, the cheapest vol in the world, the way we would have measured it in January 2022 was Euro FX vol. And, and a month later, Putin marched into Ukraine. It's funny how the part of the forest with the most dry brush and trees has a habit of finding a spark.
Yes. And it's also a function of human behavior. When you get peak crowd behavior.
Correct. Something.
You have something, anything.
Yeah.
Anything with a small rate of change, the butterfly flapping its wings.
Correct.
Can change it.
That's exactly the point. That's exactly the point, right? I'm not predicting Putin going into Ukraine. And if that risk buildup wasn't there, Putin going into Ukraine wouldn't have caused a volatility event. But in hindsight, we all say, oh, Putin went into Ukraine, he had a huge volatility event in Euro FX. No, he had a huge volatility event in Euro FX because too much leverage had gone in, selling vol embedded in that particular case, and exporters doing TARFs and TARNs, target redemption notes and stuff. And again, all of these things that, there's a commonality in the nature of these structured products. And that commonality generally is they're skew crushers, right? They're selling levered multiple times out in the wings because it doesn't look like risk within your two standard deviation distribution of the underlying. And because, again, sharp world mathematics is trying to predict X and it ignores the payout function of X. You talk to guys like me, will tell you, well, the only thing that matters is the payout function. Don't focus your portfolio around your forecast of X. Build your portfolio around your f of X, the payout function of X. And then just wait and watch it tick over. If you can create in your portfolio that convexity, where it's naturally accelerating in the good parts of the racetrack and actually decelerating in the bad parts. In the part of the racetrack where everybody can only drive at 60% capacity, you're not separating on a compounding path. It doesn't matter. It's the part where you can drive at 110% and then slam on your brakes and turn around and come out the other side. That's where you create the separation. Yeah. That's the compounding path.
Humans are so weird because they just won't pay for those extra brakes and they won't pay for insurance. Yeah. If they can avoid it, unless they're forced to do it, because somebody's going to fire them because they haven't hedged the interest rate risk too late, they don't want to pay. And it's weird.
But again, it comes back, in my opinion, to the flaw in the sharp world construction and the incentive structure, or the fiduciary world, because the fundamental flaw, Raoul, in the whole system is the fiduciary system does not have an incentive around geometric compounding. It just doesn't, and because they're working on an annual average return, and back to my race car analogy, they're starting at the beginning of the race and optimizing one lap at a time around average lap speed. And so that says to you, we'll sell the straddle. But if you started at the terminus of a 40 lap race and optimized backwards, it would tell you to buy the straddle, because the fastest parts and the slowest, most dangerous parts are what will determine who wins the race. And so it really is, I say this, if you wanted to give me one main catchphrase, it's just math. I mean, it's literally just math, just simple mathematics of how you should construct a portfolio. And in so doing, and our sort of commitment to doing that, it gives me kind of a unique window on where the sort of structurally dangerous parts of the forest are. Because I sit here and see, geez, look at all this vol supply. That's crazy. People are selling me things. If I can buy things, long dated options for single digit basis points, what is the capital logic of that, right? And sure. And again, this is what Mark Spitznagel's doing, and this is what
and Jerry Horwath in London's doing. There's a whole bunch, there's a whole group of people doing it. It's not an easy thing to do. I think people listening to this will go, yeah, that's not very easy. And it's not.
It's not. It's really hard. And don't try this at home, sort of is my advice.
But everybody became like, oh, I'm a wings guy now. Yeah. And it's the root of the poorhouse.
But they're not, right? Because they don't understand the complexity of time, because they've grown up from...
Well, they also use path dependency. So they say, I think this, therefore I will buy this.
Yeah.
Right. This is what everybody does because they saw The Big Short. Right. Yeah. That screwed up this whole industry for a long time, because you have to be agnostic on the actual path.
Yeah.
But they're not.
Yeah. Everybody's grown up. Everyone went to school and got sharp world educated. Everybody worked in the financial industry and got sharp world compensated and incentivized, and everybody's got lots of experience as an investment manager. That's not necessarily the experience you need to be a goalkeeper, right? It's different. It's different. And the relationship with time is so fundamentally different, and the type of effort required. It's not about making a good call. It's not about, I think this is going to happen, or I'm bearish on that. It has nothing to do with any of that. It's just about playing goalkeeper and just being committed to doing it, and doing it and doing it and doing it and doing it. And to us, and I'm sure you've heard Nassim or Mark or Jerry say, a calendar year to us is a completely meaningless thing. It doesn't mean anything. Who wants their insurance to run out at the end of the year? Nobody wants their insurance to run out at the end of the year, right? You want your insurance to at least be constant, if not be growing over the year, right? And so none of us work to a calendar year. It doesn't mean anything. Yeah, and the positions in all of our books would be, particularly us and Jerry, would be much, much longer dated than anybody would conceive, right? Because we're trying to play this game of time, Vega versus theta, right? We want stuff that has low cost of ownership, large sensitivity to Vega and convexity and movements, right? And then in our case, and everybody does different things, the ability to go where the opportunity is, right? The multi-asset, multi-geography, agnostic ability and skill set, right? Not everybody. There's a there's a big difference between trading options on an equity index and trading interest rate swaptions. A different skill set, a different level of complexity when you get into a cube instead of a grid. 3 dimensions and 2 dimensions is a big leap. And so, having people who know how to do that, and then obviously supply and demand is the number one important thing. And if you're limiting yourself to where access is easy, VIX futures, the easiest place in the world to buy vol, well, you're probably not where the supply and demand imbalance is favorable. You're probably in the wrong way around.
You actually want the world to continue as it is.
Yes.
Because if not, you're out of business.
Yeah. If my lifetime nemesis, Sharp World, gets corrected, if the notes that guys like me and Nassim wrote back in the 90s saying, do not embed value at risk in BIS regulatory guidelines, or you'll get the GFC, right? Do not do it. Do not do it. Well, if they ever took it out, I'd have to find something else to do for a living, right?
That's right.
I mean, if everybody got convex, if there wasn't this Sharp World willingness to, I don't like to use the word misprice, but misprice complex nonlinear structures, then it'd be very difficult to have the sort of persistent alpha that long volatility provides. Right? And the fact that it is so fundamentally mispriced in certain pockets where supply and demand get imbalanced means that there's no hedge fund manager index that has and all those indices are averages, right? There's no index that has so much consistent outperformance as the long vol index. You take long vol index and pair it with beta and risk adjust to any other equivalent portfolio, and it wins every time at the average. There's no other average hedge fund index that outperforms an equivalent benchmark. They all underperform, the put sell index, right? by miles, every single one of them. And yet the long vol index outperforms, just paired with vanilla beta and any, risk adjusted, equilibrate the downside deviation risk to 60-40 and compare it to anything you want. Right? And that's because vol is perennially cheap and has been courtesy of, I will argue, Sharp World and central bank volatility suppression. Now that may go away if they lose control of this whole thing. Now, in that happening, hopefully
we'll still get a nice payout if that happens.
Well, hopefully we provide enough protection that it makes a difference to our clients, right? Our clients, we think about it in terms of the combined package of the extra risk they're taking and how we're protecting. So, a bad year for us is usually a really good year for their overall portfolio because they were taking more risk. They had good breaks, so they were driving faster. A good year for us last year, a good year for us is a tough year for them because they're extra risk because they've all probably pushed out into the upside convexity spectrum of technology and private equity and crypto and stuff. Well, last year's a tough year, right, for them overall. But the combined package, because it over participates on the upside and under participates on the downside, compounds phenomenally well, way better than any Sharp World equivalent, risk. And it people, like you say, it's a hard sell. People don't understand it. You would never evaluate insurance on a standalone basis.
What you're saying simply is in a 60-40 world, you should just replace bonds. Well, you don't need the same percentage, but bonds don't give you convexity enough, particularly when you've got the moving inflation thing. If there's no inflation, they probably do okay, but not as well.
Yeah. So bonds, or most, what I would, most defensive strategies under participate and under protect, right? They're very inefficient. So you end up, the whole system's ended up parking way too much capital in them.
Because you can be dumb and do it. It's easy, right?
Yeah, correct. You just put it on, you're doing what everyone else did, and you ignore the fact that it doesn't compound, right? And that you're supposed risk mitigant is so inefficient that you got to park half of your capital in it with no upside. Now, obviously, when interest rates get to zero, it's over, right? There is no benefit. There's no positive yield in the good times.
No,
and
you might
there's
as well
no
in cash.
Yeah,
You might as well just have cash.
correct. Right. So, the simple example we show people, just take your 60-40, take the 40, split it 50-50 between long vol tail strategies and more equities. And so you're now 80-20. And because of the efficiency of the long vol dynamic, it's good leverage to exit. So you're now 80-40. And that 80-40 now has so much less risk, it measured as downside deviation or drawdown or whatever you want to measure as actual risk, then you might as well dial up some of the risk of your equity side. So take your, half of your vanilla beta and put it into NASDAQ. So you end up with this sample portfolio that we use all the time. We call always good weather. And then we compare it to risk parity for some reason. And, 40-40-40. And that has the same risk, downside deviation risk, as 60-40, actually a little less and significantly higher.
But it has the convexity to the upside.
Yeah, it has a lot more participation in the upside, much better protection on the downside.
So it compounds higher as well.
And so what you see through time, through those quiet vol periods, they basically track the same, right? Even though the guy has better brakes, he's still just driving at 60% of speed because it's kind of a windy part of the track. And so they kind of look the same. And then every time there's a big straightaway or a sharp corner, it separates. And so then you get into the dynamic like we've had since 2020, right? So you've now had this increase in volatility of price stability measures. First a spike down, then the spike up. And so 2020, 2021, 2022, the convex portfolio has just separated, right? It didn't have any of the...
You must be exhausted.
Yeah. And it's, it's that simple, right? Of course, then, whenever I'm talking to people, whenever I'm talking to somebody, it's because somebody has introduced me, because somebody, is underfunded. Their capital hasn't compounded like they wanted it to. And so somebody says, why don't you talk to Dave? And I said, I don't know why. Why do I talk to him? He's a tail risk guy. We're not bearish. And then I show up and they say, well, we're not bearish. Why are you here? And I said, well, geez, looking at your portfolio, I'd swear you were bearish. How come you don't have any money working? No wonder you haven't compounded. Why don't you get some efficient risk mitigation and put some money to work? And then you'll show them backward looking that something with convexity will always have outperformed whatever their 60-40 risk parity sharp rule version was. And they say, well, that's fantastic. That solves our problem. So now what's your expected return looking forward? I said, I don't know. All right. The whole portfolio is built to perform in the parts of the path that are unpredictable. I said, oh, yeah, but our expected return is 7.5% on our sharp world strategy. Well, how'd that work for you? Well, it didn't. I can tell you that this will outperform that, but I'm not going to give you, the whole sharp world thing, Raoul, whether it's the economic side and central bankers forecasting inflation, or it's the investor side and modern portfolio theory, they love to be precisely wrong. They absolutely are adamant that we must have the precise wrong number to proceed. I mean, think about, I joke around with my ECB friends, past and present. The ECB plays this game as an inflation targeting central bank, right? But the inflation they're targeting is the average inflation of everybody who none of them have that actual inflation, right? The target interest rate policy means it's absolutely precisely wrong for everybody, even if you believe the stupidity of the purpose of their interest rate targeting. And yet, they go on TV every month and say, we've run our model, and our model says our interest rate should be 2.2 for everybody. Whether your inflation...
It's the intellectual arrogance of it all as well.
Yeah, it cracks me up.
Dave, listen, amazing conversation. Thoroughly enjoyed it. I'm sure people get a lot out of it. They'll probably have to watch it a couple of times. But look, I really appreciate your time, and we'll get you back on at some point when things start coming interesting again. From when you can accumulate. You're not yet in the accumulation zone. You're probably still, as you said, managing zone, because things are still moving around. But once we have, you'll be able to get some sleep at some point.
There's still things that we're able to do.
Clearly.
There's still stuff, but I don't like to necessarily talk about the things we're currently active in sometimes.
No, and I'm not after your edge. So,
but
thank you.
I'm price sensitive.
Yeah, exactly. Yes, because it moves a lot with a very small, few basis points can make a huge difference to the payout in the end.
Let's just finish with that. And that's a classic Nassim Talebism, right? If you buy something that's priced at a 10% probability and the probability curve shifts up 10%, so it's now priced at a 20% probability, you double your money. If you price something that's priced like a 1% probability and the pricing curve goes up 10%, you make 10x your money. Price matters a lot. A lot.
Particularly when you're in the derivative game, because it's all
correct.
Second derivative orders. Brilliant, my friend. Really appreciate your time, and thank you for staying up late in Singapore for us.
Thanks, Raoul. Great to see you. Cheers.
Okay, there was a lot in this interview. There was a lot of option Greeks. There's a lot of complexity. And, David and I have both been in derivative markets for 30 years, so it's some of the language that we both speak, although he's much more of an expert than I am. But the point being is, I think there's been a lot of tourists in this tail risk world. Everybody wants to be the big short. I see that event. It's mispriced. I can be the next Kyle Bass. I think what is happening here with what David is doing is very different. It's looking at the broader world and saying, okay, where are people making behavioral errors and therefore selling things too cheaply? And could a repricing of that lead to a significant gain in a portfolio? So, he looks around the world and he's inquisitive like the rest of us and curious. And so he looks at Japan and everything else. And he's just saying, well, is it very cheap? And if it's very cheap, what could be? Could something change in this equation? I think it's fascinating, and how it outperforms a 60-40 portfolio is super fascinating too. It's not the glory of predicting markets. I nailed the CDO trade, which I'm sure he did. It's not that. It's the glory of balancing your portfolio with the right risks.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.